Hello everyone and welcome back to our FDM journey. I hope you've been practicing identifying the support and resistance levels we covered last time. Because today we are about to add something absolutely game-changing to your toolkit. Here's a question for you. Have you ever looked at a chart and felt completely lost, not knowing if the market is trending up, down or sideways? Or maybe you've entered a trade thinking you were trading with the trend only to get stopped out because you were actually fighting against it. Today we are diving into the second dimension of FDM structure. And by the end of this lesson, you'll be able to read market behavior like a skilled detective reading clues at a crime scene. You know just where the market might react, but how it's likely to behave and why. Main content, what is structure? Let me start with a simple but powerful analogy. Think of market structure like the skeleton of a human body. Without a skeleton, the body would just be a shapeless mass. And you wouldn't know where the arms, legs, or head are supposed to be. Similarly, without understanding market structure, price action just looks like random squiggles on your screen. Market structure is the underlying framework of price movement. It's the story that price tells us about who's in control, the buyers or the sellers. At its core, the structure is beautifully simple. It's defined by the sequence of swing highs and swing lows, and there are only three possible scenarios. One, uptrend. We see higher highs and higher lows. Think of it like climbing a staircase. Each step takes you higher than the previous one. Downtrend, we see low highs and low lows. This is like walking downstairs. Each step takes you lower than where you just were. Third, range. We see equal highs and lows forming a sideways channel. Picture a tennis ball bouncing between the floor and the ceiling of a room. It keeps hitting the same levels over and over. Now here's something fascinating. Structure is what we call fractal. This means the same patterns repeat on every time frame. A swing high on the daily chart might contain a complete cycle of trends and ranges when you zoom in into the 15-minute chart. It's like looking at a tree from far away. You see the whole tree, but zoom in and each branch has its own smaller branches with the same pattern. The building blocks. Let me break down the building blocks of structure for you. A swing high is like the peak of a mountain. It's where price reaches a high point and then starts coming back down. Price tries to go higher but fails and pulls back. A swing low is like the bottom of a valley. It's where price hits a low point and then starts bouncing back up. Price tries to go lower but can't and recovers. Now here's where it gets interesting. We have internal structure and external structure. Think of internal structure as the conversations between inside a building, while external structure is the architecture of the building itself that everyone can see from the outside. Internal structure is the minor swings you see on a lower time frame. It's often just noise. External structure is the major swing points that dominate higher time frames. This is your signal. A skilled trader learns to filter out the noise and focus on the signal. Why structure matters? Structure answers the most important question in trading. Where is the path of least resistance? Think of it like water flowing down a mountain. Water doesn't fight gravity. It finds the easiest path downward. Similarly, price tends to follow the path of least resistance. And structure shows us which direction that is. And with structure, we can identify trend direction, spot potential reversal zones, and most importantly, align your trades with the bigger picture. Without structure, trading becomes like trying to navigate without a compass. You're just guessing and hoping. The three states of structure. Remember our three states: trending up, higher highs and higher lows. This is where buyers are in control. Second, trending down, lower highs and lower lows. This is where sellers dominate. And the third, ranging equal highs and lows within a box. This is where buyers and sellers are evenly matched. The key principle in FDM is adaptation. We never fight the structure. We adapt our tactics to match it. It's like learning to dance with a partner. You follow their lead. You don't try to force them to follow yours. Now I want you to pause for a moment and think about your recent trades. How many times have you tried to pick a bottom in a clear downtrend or tried to make short a market that was clearly trending up? Be honest. You've all been there. Breaks of market structure and shifts. Now let's talk about two crucial concepts. Break of structure and shifts in market structure. A break of structure, or BOS, is like a runner breaking through the finish line tape. In an uptrend, it happens when price breaks above the last higher high. In a downtrend, it's when price breaks below the last lower low. This confirms the trend is continuing. It's like the market saying, yes, I'm still going in this direction. A shift in market structure, or SMS, is a car changing direction. It happens when price breaks against the existing trend. For example, in an uptrend, if price breaks below a higher low, that's an early warning that the trend might be changing. It's the market's way of whispering something might be changing here. Remember, VOS means trend continuation. SMS means potential reversal. Momentum, the engine. Think of momentum like the engine of a car. You can have the best car in the world, but if the engine is weak, you're not going anywhere fast. Momentum is the speed and force behind price movement. Strong momentum supports continuation. Strong momentum supports continuation. It's like a freight train that's hard to stop. Weakening momentum suggests a potential reversal, like a car running out of gas. Here's how we assess trend health, and I want you to remember these three factors. Number one, speed. How quickly price moves between swings. A healthy trend moves fast in the trending direction. Number two, projection. The distance traveled in each impulse move. Strong trends make big moves and weak trends make small moves. Depth. How much price pulls back during corrections. Healthy trends have shallow pullbacks. A healthy uptrend looks like a rocket ship. Fast speed, large moves up, and only small pullbacks. A weakening trend looks like someone walking uphill while getting tired. Slower speed, smaller moves, and deeper pullbacks. Impulsive versus corrective moves. This is crucial for your timing. There are two types of price moves. Impulsive moves are like a sprinter running. They are strong, directional, and decisive. These are the money-making moves. Corrective moves are like someone wandering around a shopping mall. They are slower, overlapping, and choppy. These are the patience-testing moves. In FDM, we train ourselves to enter after corrective move and ride the next impulsive leg. It's like waiting for the wave to pull back so you can catch it as it surges. Structure across time frames. Here's something that will save you countless losing trades. Structure is universal across all time frames, but you need to use top-to-down analysis. Think of it like planning a road trip. First, you look at the big map to see which direction you're heading. Higher time frame, we use higher time frame for trend direction. Then you zoom in to plan your specific route. We use low time frames for precise entries and exits. This prevents you from trying to drive north on a highway that's heading north. In other words, it stops you from fighting the big picture trend. Reversals versus retracements. This might be the most important distinction you will ever learn in trading. Let me explain the difference. A retracement is like someone taking a short break while climbing a mountain. They stop, they catch their breath, and maybe they step back a bit, but then continue climbing. The overall direction hasn't changed. A reversal is like someone deciding to turn around and go back down the mountain. The entire direction has changed. Retracements are temporary within an existing trend. They are caused by profit taking or quick reactions, but overall structure stays intact. These give us opportunities to join the trend at better prices. Reversals are structure shifts signaling a completely new trend. They break major levels and shift momentum in the opposite direction. In FDM, the distinction is critical because retracements mean opportunity to join the trend, while reversals mean it's time to reposition with a new direction. Markets follow a recurring cycle like the seasons of the year, and understanding this gives you tremendous insight. Accumulation is like winter after harsh downtrend. Smart money. Accumulation is like winter after harsh downtrend. Market movers quietly start buying while most people are still pessimistic. You see ranges and fake outs. Uptrend is like spring. Demand takes over, higher highs and higher lows fall, and pullbacks are shallow. This is growth season. Distribution is like summer, the price cycle. Markets move in repeating phases, much like the seasons of the year. Recognizing these phases gives you tremendous insight into timing and behavior. Now we will be discussing 4 types of phases. Now the first phase is the base phase, which I call winter-like season. After harsh downtrend, price cools off and moves sideways. Market movers quietly position while most participants remain pessimistic. You'll notice ranging markets here often with forced breaks as supply and demand fight for control. Now the advanced phase. It's like spring, demand steps in, creating higher highs and higher lows, pullbacks are shallow, and momentum builds. This is the growth season. Peak summer. After a strong rally, early buyers gradually take profits while latecomers rush in. Price forms another type of range filled with traps and filled breakouts, showing that strength is fading. Decline, fall. Supply dominates, reducing the lower highs and the lower lows. Rallies fail quickly as sellers press the market lower. The beautiful thing this cycle explains not just trends but why ranges appear at the beginning and the end of moves. And it repeats across all time frames from multi-year charts down to a single minute chart, bringing it all together. Remember in our four-dimensional method FDM, structure is the second dimension because it transforms those static levels we learned about in chapter 2 into a living, breathing story of market behavior. Levels tell us where the market might react. Structures tell us how and why it's likely to react. When we combine them, we start to see the market not as random price movement, but as a logical sequence of events that are driven by human psychology and market dynamics. Motivation and recap. Alright everyone, let's recap this powerful lesson. We learned that the market structure is the skeleton of price action, the framework that gives meaning to all of those price movements. We covered the three states, uptrending, downtrending, and ranging, and why we must adapt to each other than fight it, and why we must adapt to each one rather than fight it. We explored swing highs and lows, the difference between internal noise and external signals, and how to distinguish between trend, continuation, DOS, and potential reversals, SMS. We discussed momentums, the engine of structure, and learned to assess trend health through speed, projection, and depth. Most importantly, we learned the crucial difference between retracements and reversals, a distinction that can make or break your trading career. You know what? You've just gained a superpower. While most traders are staring at indicators that lag behind price, you can now read the market's intentions directly from price action itself. You can see whether buyers or sellers are in control, whether a trend is healthy or weakening, whether a pullback is just a retracement or the start of a reversal. Your homework this week is simple but powerful. Go to your charts and practice identifying the current structure. Is it trending up, down, or ranging? Can you spot the swing highs and lows? Are you seeing BOS or SMS? Start with daily time frame and work your way down. In our next lesson, we'll add the third dimension, time. I'll show you when these structural moves are the most likely to occur. You're building something incredible here, one dimension at a time. Until next time, remember, the market is not random. It has a structure, it has a logic, and now you have the eyes to see it. Keep practicing, stay patient, and I'll see you in the next lesson.